The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Certainly is the podcast by investors for investors. Phil Tarrant here, property investor and host of the Smart Property Investment Show. I hope you're well. I get a real kick out of recording this podcast. It's one of the highlights of my week. I do it a couple of times a week, actually, chatting with property investors right across Australia, keeping in check with how the best and the brightest and the smartest and the most driven property investors going about wealth creation. Helps me realign and readjust on at least a daily basis for my own journey through property, how I am personally looking to build wealth through property across a number of different streams, and I get a real kick out of it. So it's a really nice thing to do, and it's a real privilege to be able to do it because I get that check-in regularly, and it makes me think, recalibrate, recharge, stress test, and get a real appreciation about how I can potentially shape my attitude or aptitude when it comes to property to do what I do better. But a big part of the Smart Property Investment Show, which is part of the Property Investment Podcast Network, which you're tuning to right now, which has a number of different shows where we sort of cover across a whole bunch of different stuff with some of our partners as well, is bringing in the big minds, the people who are working inside of property, who are servicing property investors, supporting property investors to make more informed decisions. We like working with these people because it very much connected in with our own mantra. That is to give information, intelligence, motivation sometimes to property investors to go about doing what they do better. So people who see the world the same way as we do, they're the people we like to get onto the show. One of them is a regular guest. I don't want to talk him up too much. Paul Glossop, Director, Pure Property Investment. He's joining me back in the studio. I'm sure he's going to talk about his book, something about property investment surfing. I can't remember. He tells me it's a bestseller.
I'm disappointed in that introduction because you spent 2 minutes then having the absolute perfect opportunity to reposition me at the bottom of the barrel, because when those people aren't available, we get the dregs. And to welcome me today, I've got Paul Glossop. You knew it was set up. You were debating that whole time whether you go one way or the other. I know you were.
Yeah. Anyway, well, I wasn't actually mentally doing that, but I knew sort of there's probably an undertone I could trigger a particular way. People would be nervous, Paul, if I was too friendly to you. This is the problem, right? You know, if there's a certain culture and expectation around how I should be presenting people like you, maybe I can come up with a new theme of those property investment advisors I dislike. Maybe that's probably cool. a better podcast that people will probably tune into more. Probably go, oh, Paul Glossop again, that bloke. Pure property investment. Oh yeah, what's he going to talk about now?
I like it. No, mate, I'm good. I know we've chatted a fair bit in the last few weeks. It's been a busy couple of months, and we're at the point now where I went out for an actual meeting face to face with a couple of clients as of yesterday for the first time in a number of months, and life started to feel
a bit weird. Did you shake the people's hands?
There was that pause, that awkward hesitation, whether it's the fist bump or the handshake or the Korean bow or
what is it, the namaste sort of
namaste. I think we've got this. I mean, we're really embracing the whole multicultural aspect of Australia now, because I think the greeting side of things will never be the same. It's very interesting, and combining that with watching Squid Game over the last.
Are you watching that? Are you watching Squid Game? Are you?
I've done it, but looking at a lot of the cultural changes and everything that goes with it, it's quite entertaining. But I'm glad I got that, because I probably wouldn't watch it again if I was out.
Give me I haven't watched Squid Game. I've just sort of become familiar with it, and it sounds all a bit weird. But give me an analogy or a metaphor of Squid Game and how that applies to Australian property. Here we go.
Oh, Jesus. I thought you were about to say give it to me like in a comparison of another point in time. Essentially, it's kind of like the Roman times where essentially it's like Gladiator. You put a bunch of peasants or desperate people in a cathedral. People
sounds like property.
Pretty much. And essentially the people, typically you've got to just be careful because ultimately you've got the puppeteers who sit at the top pulling the strings, now whether they're government, whether they're spruikers, whether
that's Phil Tarrant from the Smart Property Investment Show, orchestrating property.
They orchestrate what's going on, and then you've got essentially everyone feeding in from what they've got to offer to say, well, I want it. And ultimately it comes down to greed and money, and that's why everyone's in that. And you'd like to think that you have the choice. Squid Game, they have the choice of exiting out of it or not entering into it at all. Is they're like, I actually don't need the money, or I can find better ways to do it, or they can take their own route and think, look, I don't need to do it quickly, because essentially goes back to that thing we talk about all the time, which is delayed gratification versus instant gratification. And anyone who chases that money over a short period of time typically are going to be in a very bad way.
Well, here we go. So here's our headline: Squid Game meets property. The first time in Australia that someone's applied the logic and the gamification of Squid Game to the game that is property investment in Australia. I love where this goes, mate.
It's human instinct. And, it's so funny because we talk about Squid Game property, we talk about crypto all the time these days. The last 18 months in a massive run-up of the ASX and the NASDAQ and every other equities market across the world. And, the day of reckoning always comes for those who think that, good times last forever and that you're essentially throwing caution to the wind in every single investment that you make. And it's coming close. And I'm not saying that we're at doomsday, but I do look at these types of scenarios, and we've seen it so many times before. And I think we'll probably be able to delve a bit further into that today. But what happens when people just get too bullish on chasing short-term money?
And I haven't watched Squid Game. I've only read about it, so I don't really know too much about it. But I quite like where we're going with it. So, how do you win Squid Game?
Essentially, you need to persevere. You need to outlast everyone else, which is outwit, outlast, outplay. And I think ultimately there's 468 players who start that game, and only one person can walk away with what's about the equivalent of $50 million, and everyone else perishes. Well,
they actually die?
Potentially. There's a few twists and turns in that show, which I won't give away, but the vast majority of people don't exist after the end of the Squid Game.
So what are your 5 top points for winning in Squid Game and the same application in property? Give them to me on the fly. Go.
5 points. I'd probably break it down to probably 1, which is don't play it, because the odds are stacked against you. From day one, if you're thinking that that's what you want to be involved in, and we talk about, analogies of going to the casino, flipping a coin or whatever other way you want to try and make money, for me, it comes back down to if that's the way you perceive how to find and get instant gratification and success, it's basically like winning the lottery. And the chances of that are, as we all know, are slim to none.
So property is a much better vehicle than playing games like Squid Game or going to the casino. You can control it a lot more, can you?
Unequivocally, you can control it, and you will not make that money in that 2-week or 2-month period. It just won't happen. Simply, it is a game of delayed gratification and patience. And it is a game of decades. It's not a game of days.
Game of inches, game of decades. It's a game of everything, right? So, but property is a game. Yes, no?
Oh, absolutely. I mean, one of the most sold board games of all time, Monopoly will attest to the fact that it is essentially the same. Is that you stay there long enough, you acquire, you try not to sell, you manage your cash flow, and Bob's your uncle. You end up 6.5 hours later, the loss of 2 family members on arguments along the way.
Who's the banker in your family? Because the banker's normally got their finger.
My son's definitely the banker. He loves it. Loves to control the money.
Yeah, loves control. Who's your Park Lane buyer versus your was it Whitehall?
Yeah, I think my wife's the Park Lane buyer, which is for me, it's still a dubious strategy. And I think the statisticians out there would probably note that you buy on either side of go. You're typically not the places you've got to buy on the back end of get out of jail and go to jail. They're your money markets.
That's where you make good, sustainable, long-term gravy.
Cash flow and capital growth. And
what about utilities? Are you buying train stations and waterworks, or you stay away from that stuff?
I think there's a place for them, for those who, and they're usually bought after you've acquired. So they're
your commercial properties, right? Once you've built up a good resi portfolio. Correct. It's a great game, Monopoly, isn't it?
You can talk about it all day. You can talk about it all day. The strategies, the negotiations, the ways that, part of it is the plan, but essentially plans don't go to plan a lot of the time as well, and you got to move on the fly.
So we've got kids of similar age. Are you playing the adult game with them or the junior Monopoly?
No, we're playing the junior Monopoly, as well as I did have a friend give me the Northern Beaches Monopoly.
Oh, of course.
Which, as a non-Northern Beaches resident, we've used as a coffee table. no offense to the Northern Beaches.
It's all junk property, right? Northern Beaches.
It's full of junk.
Well, it's funny, and this is the intersection with the gamification for enjoyment versus, in some ways, the actual gamification of property. It's about, I've always said this, if you make the rules, typically you can win the game. And in property, the same applies. Yes, you're operating in an environment that you can't control in many ways, all those macro and microeconomic forces or factors which are shaping property. But how you choose to approach the game, the way you set about your own gamification of it, your capacity to borrow property, what your strategy is, what your long-term goals are. If you get that right, that means you create your roadmap for winning the game. And that's what the best property investors do, mate.
Yeah, I completely agree. Absolutely. And I think that's never been more true than what it will be and has been over the last couple of years, when you've had everything and anything that's presented itself to investors, and what will come of the next couple of years for those who probably are in that, going back to the Squid Game analogy, thinking, oh, geez, what's happened with this whole property thing? I'm going to jump on that ladder and really just throw caution to the wind and just chase where everyone else has already bought, or thinking that there's quick money to be made in really, really expensive areas because they've had exponential growth, and that'll continue on for the years and decades to come. Yeah, that is a very, very interesting, and collaboratively, I think it's going to be one of the probably the more exciting markets for good and for bad over the next 5 years.
Yeah, and the best property investors I know always look for clues for success outside of their own ecosystem or environment. All the clues inside property don't all exist in property. Did you watch SAS Australia? I
watched bits of it. I did, definitely. I know you're a big fan.
I watched the uncut version because I really enjoy the swearing of it. Those guys,
people getting broken down to the M10th before they ask to leave, and you just love seeing people at their worst.
But you look at that and you just think, okay, it's a TV show, but it's a really good experiment and insight into resilience and mental fortitude versus strength and clout. And again, there's clues in there for property investors. Around mindset. And I know, I was sort of giving you a hard time about your book earlier, but, the big part of your book was around mindset. And you watch that SAS Australia, watch the uncut version. Spoiler alert for those. I've just watched the final version. I won't tell you who wins, just in case you haven't done it yet. But it all comes down to mindset. Mindset always trumps the physicality of it all. And you put that again into the context of property investing. Your mindset, irrespective of the hardships investing in property, the hardships might not be physical necessarily, but they may be emotional, they might be financial, they might be structural. There's going to be a lot of stuff which you're going to come up against as a property investor, buying, holding, sustaining, selling property, which if you can calibrate your mindset, and you talk about it in your book, you calibrate your mindset correctly and have a good relationship with the stress associated with it, that's when you can excel in property and can make all the difference. So there is another clue there.
Completely, mate. And I think these are the times where I look at the Australian property market, in particular, some markets which have done amazing things. Like even this morning, I've had 2 different meetings with 2 existing clients of ours, one of which we bought a couple of properties in parts of Tassie for about 3 or 4 years ago. And I'm happy to say that to them that, that we've seen about 65, 70% growth in both of those properties in that time. And they were only bought in the early 200K price points, and they've just extracted about 200 grand in equity. And we're looking to push forward with different assets in different markets. But that's not going to be the norm. And for me to condition those particular clients to say, what's happened here is phenomenal. And I'm really, really excited and happy that we've been able to probably expedite what the plan was 3 or 4 years ago when we started this, probably by double that time. And I would never expect, 15, 20% compounded annual returns for that time. And I'll never plan for it. But when it does happen, to try and then to say to that person, these next properties we're going to buy, don't plan for us to go out and say that we're going to cap again in 3 years' time, and those first 2 properties have gone another 60%, and those next 2 properties have done another 60%. All of a sudden, we've got 400 grand's worth of available equity to go and put into the next 4 properties. It simply doesn't work like that over the long term. So to your point on mindset, we're at this point now where the juncture is there. We will see growth, and we unequivocally will consistently see growth in different markets. It won't be this ubiquitous position across Australia over the next 18 to 24 months that we just saw. And people are going to have to stay strong in the sense that you're going to start to see more headlines talk about doom and gloom. And this always happens at the back end of, or even at the middle of growth cycles, where people talk about bubbles, they talk about cash rates going up, they talk about people being in predicaments and situations where they can't have any cash and they're going to have to sell under duress and they're going to lose everything, including their family home. The reality is that majority of this is hot air. But people do need to prepare themselves mentally as well as then factually as to what happens when these things do happen, not if they happen, but when they do happen. And that's a big part of where I am really cautioning a lot of investors to, not just now, but all the time, because you'll have won't necessarily have a pandemic every year, but you will have a scenario which sparks your interest and makes you think, shit, what happens if that actually happens to us? Are we okay? Are we going to be okay to do that for not just 2 weeks, not just 2 months, but maybe 2 years, 4 years, 5 years? And I know you've recently personally sort of gone through this over and over to find a property that you're looking to buy. And it's, you're looking at making a significant investment. You have to make those significant investments in property with the knowledge that, you know what, I'll probably see some really bad headlines and potentially some actual factual shit data that's going to come out in the next 2, 3, 4, 5 years. But am I okay with that? Yes, because I don't intend to buy this property and sell it in 3 years or 5 years. I intend to hold this property for potentially ever, but most certainly 10, 15, 20 years as a minimum.
Yeah, and this is irrelevant sometimes, the irrelevance of time, but also the relevance of time. And there's two sides to that coin. The relevance of time is if you're transacting property, it becomes super important, as in buy, sell, buy, sell, buy, sell. You got to get your timing right. Timing largely becomes irrelevant when you're thinking of 2, 3 decades or generational assets, because by and large, you're going to be okay. But it's what is the out though? If you do go down that pathway, a lot of people are probably sitting going, what are these two idiots gibbering on about? Monopoly, Squid Games, SAS Australia. What I am happy to report for you, Paul, is that our good friends at the tax office tune into this podcast. So when your Netflix subscription's on there as an expense for business, you can justify that.
Highly claimable.
But talking about it, but mate, the reason I really wanted to have a chat to you today around how these, or whether you're seeing yet any impact of these APRA recommendations to the bank. So we'll get into that. We'll just go to a break beforehand. Stay with us. Back in a moment.
Are you wondering where to buy an investment property right now? Why not let buyers take the guesswork out of it? We can find you the right place on or off market at the right price. An investment professional from our national network of buyers agents can help you save time, money and stress and deliver you a tailored solution. Talk to us today. Call 1800 975 051 or visit buyersbuyers.com.au.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Paul Glossop, a director at Pure Property Investment, a buyer's agent, property strategist. What do you prefer, buyer's agent or property strategist? Or
look, we're buyer's agents. First and foremost, we're buyer's agents. That's our job.
Yeah, and so you help people buy property, essentially.
That's pretty much it in a nutshell.
Okay, good property for them to meet their needs.
Correct. Hit their budget, meet their needs and their portfolio exposure.
Pretty straightforward. We'll chat offline. There is this sort of groundswell now around this subsector of real estate buyer's agency. It's been sort of bubbling along for at least a decade now. Some early pioneers were pretty early on in it. Now it's really starting to find its feet, which is good to see. So how that looks like into the future, who knows? At least we're diarising these chats in 30 years' time when it's a huge industry, and that's the way how a lot of Australians buy property. They can go back and listen to us talking about Squid Game and stuff. But most recently, Paul, and we know we've reported on smartpropertyinvestment.com.au that APRA has written, this happened last week, APRA has written to the banks and pretty much said to them, hey, you need to start thinking about people's serviceability different. If you're not across this, I'll explain it really, really quickly and as easily as I can. When you go to a lender now, they will add 2.5% on top of the interest rate that they will give you on the basis of whether or not you can service that debt. What has changed is now APRA has recommended or asked or told lenders, you work out which one it is, that needs to be 3%. So it's not 2.5% anymore, it's 3%. So what that means is that you cannot borrow as much money, and the quantum of that, depending on how you want to slice and dice your numbers, probably reduces your borrowing capacity by about 5%. That is how it washes through. Is that a pretty clear description of that, Paul? Is there any way? Would you add anything to
I
that?
think you hit it bang on. Is that there's going to be a few different ways it'll be sliced depending on how income's generated in different people's or different lenders. I guess specifics around how they'll calculate serviceability. But in short, the intention is that by the end of this month, we're looking at probably circa 5% limitation of borrowing capacity compared to what is there right now.
Yeah. And a lot of people go, so what? Who cares? That doesn't make any impact to me. So I want to have a chat to you about winners and losers when it comes to this, Paul. And I've had some discussions around it over the last few days. I think one of the losers would be first home buyers. We'll get into that. But the logic behind this, and sort of I'm not speaking on behalf of APRA, this is just my interpretation of it. And APRA is the Australian Prudential Regulatory Authority. So they're a government body who pretty much sit there and make the rules, and they don't necessarily enforce the rules, but they make the rules around how they want banks, amongst other things, but how they want banks to issue credit. So they're connected in with the government, the Reserve Bank. There's a whole ecosystem there, and they sit there going, all right, how's the economy going? Which directions is it going? Is there anything we need to be concerned about? How do we sort of stop things, start things, move things, et cetera? What buttons and levers can we pull? One of them is APRA intervention into how lenders make finance available. And we've seen this before. We've spoken about it at length all over many years. There was APRA intervention back in 17, 18 by memory on the purpose of trying to slow down investment lending. They went, things are a bit out of control. Property's going up too fast. How do we stop it? There seems to be a lot of investors in the market. So let's cap banks' ability to grow their investor book. So therefore, banks made it a little bit harder for investors to get money, less investors in the market, slowed the market down, and some places went backwards, right? Criticism then, Paul, was that you've done that to try and affect two markets, Sydney and Melbourne, when we've got other markets which are hemorrhaging and bleeding. You're just impacting them. That would have been Perth and Brisbane to some extent. So this is APRA coming back in. We've telegraphed this. We've been speaking about it now, mate, for about 3 to 4 months, saying this will happen in time. Wait. And to use your language offline, you said this was really the first bullet in intervention to try and shape in a positive and sustainable way price growth. You think this is the first? Is there more to come?
Yeah, I think absolutely, man. I think they've learned numerous times. And you talk to those who are in the know from an economic standpoint at the moment, and there's a lot of conversation now around the RBA governors, probably language around the fact that they're constantly reiterating that interest rates won't change till 2024. Now, to a degree, they've built a rod for their own back because they can't really change that now. And I personally think it's probably a tough stance to take, because how do you control what's happening over the next 2 years? But that being said, obviously the intention is to give confidence to people in the economy to both spend money, to understand where their money's going to be, what their money's going to cost for those Australians who have a mortgage, which is obviously a larger portion of those. But in the same vein, I think they also now have confidence that they've figured out prior to this pandemic that the previous downturn, essentially that what led up to the Royal Commission into the banking sector, they realised that ASIC and APRA can do a heck of a lot more to the housing market than tinkering with interest rates. So I think the first step and I guess going back to really some of the facts of what happened back when it did happen in 2017 to 2019, more or less, we had obviously a federal election, which at the time was pretty much a foregone conclusion that Labor would be voted in and that we would see some big changes to negative gearing, which, as we know, history showed that didn't happen. So there was a bit more fear mongering around that. But at the same time, we saw this implementation of this floor of serviceability, which was sitting up around that mid 7%. And essentially they abolished that 2% or 2.5%, which we're talking about now, the difference between the actual rate that people are being charged and what they get serviced at. It was being serviced at mid 7%. And that was it kind of implemented almost immediately. And if we go back to that, and we have short memories, but Sydney market as a whole went backwards by close to 20% over a 2-year period. And Melbourne went backwards by close to 15% over a 2-year period. So that was only 2 years ago. So, we talk about this like it was something that was a previous generation. This is literally 2 years ago, pre-pandemic, but just before it as well. So you've got to think that the intervention of changes to access to money basically is pretty much proven. And in that same time, we've actually seen interest rates drop by 1.5%, but then that was abolished. Now we've got this new floor ceiling. So I guess I'm rabbiting on a bit there, but the reason why I highlight that is that I don't think we're going to go to the serviceability cap rate of where we are now, which is, call it 5.5-ish, maybe 6%. It's probably hovering around there, what people are serviced at. We're not going to go to 7.5-ish, 7.75%, because that's essentially going to probably take out another 10, 15, 20% of borrowing capacity, which would have that same net effect. But what we are probably going to do is have that, which has just been implemented, probably in combination with a couple other things. And I think one of the things that will probably be implemented is a change to the actual multiples of your income versus what you can borrow, or essentially your total multiples of debt to income ratio. And that for me is something that will be affecting different segments of the market as opposed to just investors. And the good news about all of this is investors aren't really making up the same proportion of the market that they were back in the heady heights of the 2015-16 timeframes, where you had almost half of all loan originations were to investors. And then even worse than that, a large portion of those were to interest-only investors. The interest-only loans essentially are tracking at close to 20-year lows now. So interest-only is something that's great to see that the interventions are there. They may start tinkering that, but I don't think that would be the case. I think it'll be this debt-to-income ratio potentially of this 6 times is probably one of the major things which will be implemented a little bit further down the track, and it's probably intentionally going to be done in a staged approach. And I think there's going to be some markets which will be impacted a lot more dramatically on that aspect than there will be in other markets across Australia. And that'll start to show this bigger divide than this 20% national growth that we're currently seeing. We'll start to see more patchy markets then.
Yeah, and it goes to show how quickly market cycles can shift. And to your point, we saw 15, 20% drop in those key markets where the intervention was directed, Sydney and Melbourne. Like everyone's been talking about, hey, we've had 23, 24% growth in Sydney this last year. It's just really getting it back up to where it was in many ways. Like, and this is like, is that real growth? Well, it's manufactured growth because what do you want to call it? Price drops were manufactured. So it's just really getting some equilibrium to it all. So this is how all APRA and the banks and the Reserve Bank and the government all operate in unison to try and shape this. The government is positive about economic recovery. And you might have tuned into it. We had a really good chat with one of the directors here at Momentum Media, who I invest in the smart property investment portfolio with, Alex Whittle. I had a really good chat with the treasurer just the other day, and it's on this network if you want to go and listen to it. He's pretty bullish about economic recovery coming out of COVID-19. A lot of the stuff I'm reading around it, you would have seen Paul, I think the treasurer just yesterday or something has come out pretty much going, they were sort of expecting 2% sort of GDP growth over the September quarter pre-pandemic. They're now saying it's going to be negative sort of 3-ish, right, as an impact of the virus. Now, you go into a recession when you have 2 quarters of negative growth. Whether or not we'll see that, who knows? The first lockdown here in New South Wales, at least, which was more of a wider Australia lockdown, we did go into a technical recession, but we bounced back out of that. They're talking about 2022 being boom times, right? Yes, we might have negative GDP growth, but yes, we might technically go into a recession. I doubt it, but that's going to be reverted pretty quickly. So there's a whole bunch of macroeconomic stuff that's going on to try and shape property markets moving forward. So when you talk about this APRA intervention, saying to the banks, hey, just look at things a bit differently and be a little bit more conservative. In summary, there's going to be people who do win and do lose around. I was chatting with my accountant the other day and he's going, Phil, not a big issue. You got plenty of serviceability, mate. Don't worry about it. And as an extension to that, and people in similar situations, and probably yourself included, Paul, is that if there is less people in the market because they can't sustain the price points, that means there's going to be less competition for property, which potentially is going to slow down that market and present more buying opportunities for those who are prepared. So those who are prepared, those who have some cash in the bank, those that aren't over-serviced, they aren't over-leveraged, it might be some good time to do some buying. On the flip side of that, if you're buying property right now or you've exchanged on something that's settling and may change your ability to get the price that you need on that, point number one. Point number two, for first home buyers who are probably, and most of them, it's just the way it is, are buying at the peak of their affordability purely because in Sydney, at least, if the median price is $1 million, most people are probably at the peak of their affordability if it's their first home. That's going to change the sort of properties they're buying. So they may need to change their plans. They may need to shift a few suburbs out even further. They may need to get a smaller property. They might need to get a unit instead of a house. There's a lot of big what I've said there. So winners and losers, there's definitely both. Would you extend on that at all?
Massively. And I think, we could talk about this literally. You could put probably 10 episodes together and break this down into so many different segments. But I completely agree with you that I think the next 2 or 3 years are going to be wildly interesting in the sense that we're going to have an economy that's going to go kaboom, and will most certainly go kaboom on a few different fronts. I think I heard the stats on we're short of about 120,000 skilled migrants at the moment for literally jobs that exist here and now that we don't have the skill for. So we're going to have this. And to be fair, when we do get to the point of opening those borders, we're going to need apparently about 160 to 170,000 by that time, which will probably be 4 to 6 months. So we're going to see this mass influx, regardless of whether we like it or not. Once the borders are open, we're going to bring skilled migrants in first, and then we're going to bring holiday makers in essentially last. But they're going to come in, and the data has suggested for the last 30 years, when those skilled migrants come in, they're typically going to come into the East Coast from parts of Melbourne, parts of Sydney, parts of Brisbane, and there'll also be some pretty strong demand in parts of Perth for a lot of skilled migrants that are needed there for certain roles right now. So what that does is that the data suggests that those migrants rent for at least the first 2 years. So all of a sudden, where we're seeing this softness in a lot of these probably apartment markets, they'll probably start to see that equilibrium return. So you start to see the yields return back to where they were. And then eventually you're going to see also first home buyers, they will be impacted, but they're always the ones who are most impacted, because when you're buying your first home, you're always stretched because ultimately you have zero other assets and nothing else to leverage yourself on unless you've got the bank of mum and dad, but that still only helps you with a deposit. It doesn't help you with serviceability. So the reality is that nothing will change on that front, is that when you look at that LVR curve, the earlier you invest, the higher your LVR typically is. And over your life, typically you see that your assets increase in price, your debt decreases in value, and you end up with a higher LVR. That's just the way it is. And it's the way it's always been. So newsflash, nothing's new there. For me, though, that the scenario that you talked about for those who may be saying, oh, I want to buy that family home, and in particular, if you're in Sydney or Melbourne, I think they're the ones who, if let's say you already have a smaller home or an investment and you want to buy that family home, the prices are very restrictive right now. And I do see, and I literally had a conversation with a potential client of ours yesterday afternoon who's got an investment in Newcastle, which they only bought, and they didn't buy it through us, but they only bought it about 8 months ago. And yeah, there's a little bit in it, but not much. They're running about an 80% LVR on that. They put a 15% deposit. They're seeing a little bit of growth. It might see a little bit more growth, but they also want to buy a home somewhere in Southwest Sydney. Unfortunately, for an entry-level home in Southwest Sydney around the Raby, Campbelltown area, you're talking for a 70s red brick, you're talking $8, $9, $1 million for a 600 square metre basic home that's, technically potentially a starter home. And they did their math. They said, well, we're going to take 10% equity out of Newcastle. We're going to pay LMI, take that deposit. We're essentially going to buy this home at 105% LVR because they're going to take the debt out of that, buy that, essentially have that fully geared up. And based on their income and essentially where they sit, they have no buffer in that situation. So they're the people who I think are going to be most at risk, essentially going back to if we see this 6 times income cap being implemented, is that A, they'll be caught short. B, they hadn't started a family yet. One of them was a contractor as a teacher. They may choose to go full time, but they're also probably going to start a family in a couple of years. And all of a sudden you go down from an income position and you say, well, what happens there? You're running negative equity across 2 separate assets. And potentially you've got zero backstop as far as cash buffers, income buffers, etc. They're the people in that cohort, for me, who have very little room to move, and basically their parachute has already been used. So if I was cautioning anyone in these types of situations, I caution those who are trying to be too bullish, as well as take themselves to the top end on a home. On the flip side, for that same client, the other option they've got is to say, well, don't take yourself to 800, 850 borrowing capacity. Consider maybe renting in that area, because you also know that you may not live there forever. Rent where you want to live. It's close to both of your homes, your families, and essentially work, but maybe consider investing well below your cap in that 400 to 500K region. So you've still got buffer, you've still got an opportunity to, if things go pear-shaped, there'll be starter family, your cash buffers aren't going to be exhausted very, very quickly. So they're the types of things that I think people are starting to consider now, to say, well, we talk about rent vesting, you and I feel, this term for years and years now, and, it's pretty much common vernacular out there these days, but it truly is options for those who live in major capital cities and want to be in those expensive areas. It's something that's becoming so much more mainstream, and I'm comfortable that people are making better choices because of it, because they genuinely aren't in a position where they are absolute red line, regardless of which way they go.
Yeah, and it's definitely The right questions to be asking if you're an investor, whether it's an owner-occupier or looking to boost an investment portfolio, is that what does all this mean to me? And I'll tell you what, get yourself a very good mortgage broker. They'll be able to steer you through all of these type of things. However, this is bank intervention to try and slow down people's debt levels. Yeah, but it's not their responsibility. And it's not the government's responsibility for people to be responsible for their money. It is your responsibility to be responsible for your financial health. Obviously, they're intervening because some people, there's a cohort of people who aren't doing that, and they've got concerns about rising debt levels. And this is a big issue. It comes down to yourself. There's no one else to blame other than yourself if you make the wrong decision, because there's so many ways to help you through that. Mortgage broker will really help you out. Your accountant will really help you out in making a decision. So make sure you talk to them. But this is a personal level, Paul. There's got to be some structural challenges at a suburb level as a result of this. And I want to get into that because this may determine where you're looking to buy investment property at the moment. Let's go to another break. Just give us a sec. We'll be back and we'll get smack bang into that. It's going to be pretty interesting. Back in a moment.
Do you want to achieve wealth and passive income through property investing? PK Gupta helps a community of over 10,000 investors achieve passive income by buying top 5% growth and simultaneously positive cash flow property using data, without wasting months doing research, spending weekends at inspections, or dropping $15,000 on buyer's agents each time. So, if you're overwhelmed with information overload but don't want to drop $15,000 on buyer's agents each time, check out PK's website, consultingbypk.com.au, and learn to build passive income through data.
Welcome back, everyone. Phil Tarrant, Paul Glossop chatting through only games of chance and how that applies to property, but how APRA's intervention is going to shape things moving forward. There's a report recently, Paul, top 20 sort of impacted locations as a result of APRA. So one thing we have in abundance in the property investment space is data. And you can typically get some data points and put them all together in a magic box, shake it up and get some applications of it. But if people have high debt levels in certain locations, that may structurally change the fortunes of those locations moving forward, up or down. So I thought we'd get into that. You've got this report in your hot little hand. Can you give me a summary, mate?
Yeah, and this is anyone who's been following property data for quite some time and going back to that 17 to 19 downturn of particularly the Sydney and Melbourne markets and what happened when you got the regulatory authorities intervening, is that what we expect, and the data in this report is somewhat similar, is that what's anything that changes your serviceability based on both your income as well as what price of money you're going to be borrowing typically affects that first home buyer, because they've got they're on the lowest income, they've got no assets, and they've got very, very large amounts of debt they've got to take out. And it typically also affects the higher end, because ultimately that higher end, even though they might have multiple assets, they're living in those expensive areas, which are essentially that top 10% or that top 10% decile of that whole market. So within this report that talks about, well, what happens if and when we see this intervention, the data suggests that it's those same markets which will probably lead the downturn or the cooling of the market. I wouldn't necessarily say downturn, but I'm going to lead the cooling of the market. And if we go back, I remember the markets of Waverley, I remember back in 2018, it saw well over 20% decline in a single year. Bronte, well over a 20% decline in a single year. That market's done 40% of growth in the last year. But they're typically the ones to lead, and they're the ones to firstly show the downturn and the retrace. So the markets, and if I rattle off some of the house price median versus median household income, now this compares ABS data versus essentially immediate income or price data. But the biggest challenge with this is that we've obviously just had a census, and the data of the census isn't out yet. So I'd probably preface some of this data in the sense that it will probably change, and it won't be as drastic as it sounds, because a lot of this income data is factoring in, I believe, ABS data from 5 years ago. But the areas which have got the highest priced income ratios, eastern suburbs of Sydney, sits above 20 times average household income to the average household price. Now, that doesn't necessarily mean that everyone's taken out 20 times the actual debt that they earn, but that's where that sits. So number one, eastern suburbs of Sydney, followed by North Sydney, which sits at about 16 times. And then essentially you can get a pretty common theme. And then it goes to the northern beaches of Sydney and inner west of Sydney, which sit around 14, 15, 16 times. And then also it goes, and these are all Sydney-based markets, and it goes to Ryde, which anyone who's based in Sydney market knows that that's another market too. Very corporate orientated, lots of headquarters in the North Ryde area, Macquarie Park. You got Macquarie University in that precinct as well. And then it starts to go over to other markets that are very similar in Melbourne. So you've got the inner east, inner south, and then you've got the inner west of essentially those Melbourne markets. So that sort of 5 to 8K ratio or radius where you push out to those markets. Again, they're all sitting well above 12 times. And then it goes into markets such as the inner south, as well as the southern suburbs of Sydney. And then effectively it sort of goes up and down the east coast to certain pockets of New South Wales and certain pockets down towards the Mornington. The only real one outlier in that of that top 20 is the inner Perth markets, which again is the only market that sort of sits down towards the bottom of that top 20 list. So the reason why I guess I highlight that, and I don't go necessarily through the nitty-gritties of specifics, is that some of that data will be updated, but it's very, very clear when you look at which markets are most at risk when you see intervention, that they're typically going to be the higher price markets, because ultimately people earn more. They also are spending far, far more on their properties. But it also suggests that the fail-safe or the backstop is that majority of the owners in those areas have had properties for a long time. That wouldn't be their first purchase. Typically, they've probably already seen 2, 3 or 4 properties before that and are upgraded, and potentially also hold other assets which are producing other income, as well as have larger wedges of equity elsewhere. So they actually have different reserves available for them. So as much as the data might suggest they can't borrow as much, which will unequivocally be the case when we do see these further interventions, they're not necessarily going to be the ones that are at highest risk or highest risk of default. So I'd probably make sure that we delineate what that definition looks like, because it doesn't mean that these people are going to fold on their property immediately, because they've usually got far bigger reserves than people who are starting in the market. But it does mean that if you're aspiring to get into those markets, once we see these interventions, you're going to find it far harder. And that also then impacts price, because people can only pay what they can pay and what the banks will allow them to pay. So if you start to bring that down by 5%, potentially another 5%, you bring down the whole cohort a bit lower and lower, and effectively you start to control price. And that's what we expect will happen. But what isn't in that list and what we don't expect to probably be as impacted, and this goes back to that couple of years back as well, is the lower price and the medium price suburbs in good, robust markets that have got good, strong economies, which will be a vast majority of Australia for the next few years. They still look very rosy.
Very good. Well, let's keep our finger on the pulse, mate. This is just really the beginning. All this stuff comes into place 1 November. It's going to be some time before you really see a true impact in this. There is so much environmental pepped up demand in property in Australia. Yeah, they speak to people like Tom Panos, one of the auctioneers, and he's clearing everything he's selling on a Saturday. So there's still a lot of energy in the market that will drive this forward, irrespective of this type of stuff. This is something which is telegraphing probably change in I'd say sort of 12 months time from this sort of latter part of 2022 is when you'll start seeing this play out. So be aware and be conscious of that. And, you know, for those of you who are potential winners in this regards, i.e. winners in this market are going to be those who are finance ready and have a good strategy in place. There's going to be some good buying for you moving forward. So, you know, get used to the fact that property is a game of markets. Markets move quickly. And there's lots of reasons that force market movements or market changes. And let's remember also, the property market isn't Australia-wide. It is at a suburb level, as sometimes at a street level. So it's different rules of engagement in different markets at different times for different people. So it is unique. Your ability to invest in property is like your DNA. No one is like you. So make sure you get the support that you need, including, and I would say most primarily at this moment in time and always, a mortgage broker. 60+% of all mortgages now written by mortgage brokers. You're mad if you don't use one. Is my view. Do you want choice and competition for your home loan? So thanks, Paul. I really enjoyed the chat today, mate. That was good, mate. I'm going to watch Squid Game. Squid Games? A Squid Game.
Squid Game. Squid Game. I think it's just Squid Game. I could be corrected by your hundreds of thousands of listeners, and I apologise in advance if that's the case.
All right, go on, mate. That's Paul Glossop, Pure Property Investment. You can still get your book though, Paul. Come on.
Absolutely. Jump on the website, purepropertyinvestment.com. I just got an update from my publisher, actually. We're going through a print run for Christmas.
Oh, really? Is this going to be like the second version of it?
No, it's the same one.
Same.
She said, look, it's going good enough to do. I think we're up to close to 8,000 copies out the door now. So there will be another iteration coming in the coming year, which will take into account what we've just seen over the last 2 years, which is pretty exciting.
How does it make you feel that you spend all this time, energy, and effort creating a book and you sell 8,000 copies, which, by the way, is a lot of books. It's a bestseller, but, there's 10 times that many people listen to one episode of the Smart Property Investment Show. That must make you feel a bit sad.
Well, mate, at least I've kept houses warm, and people have sort of got past or got past just the prologue and just read far out. I'm not going to go anything past this dribble that Phil Tarrant's written to start. Yeah, so that's what we've done, is to start a lot of outdoor fires. We've connected people by conversation around fireplaces. I'm proud of that.
Yeah, it's good, mate. It's really good, and I recommend, and for anyone, and you see it a lot, the dynamics of property investments with couples, and irrespective, whatever your definition of a couple is, it's irrelevant, but a lot of people do this together. A lot of people are weird. Everyone largely invests in a syndicate when it comes to property, i.e. your partner. So it's good that that if you're on the same page. And my recommendation would be, normally you see dynamically, Paul, there's one partner who's like the primary, and sometimes the other partner's a passenger. What works really well in property investment on that basis is, that's got to be a natural dynamic, and you've got to enhance that. But make sure the socialization of the objective, the socialization of where you're going, the socialization of what the outcomes are, if you can get that combined force, you can do a lot better. And a book like yours, give it to your partner, say, hey, read this. It's pretty easy to read. Just that would spark probably a lot of chats over a glass of wine on a Saturday afternoon.
Absolutely, mate. Absolutely. And I'm stoked with it, to be honest with you. The amount of conversations we have these days about certain chapters in the book and what people have taken from it and gleaned from it, and how it's helped them sort of just to get to clarify certain areas. And for me, it's not to revolutionise how to invest in property. It's essentially just to hopefully dumb it down and give the bare bones and semantics of what it all means. Well,
property should be simple, right? If it isn't, make it simple. Anyway, Paul Glossop, Pure Property Investment, smartpropertyinvestment.com. You go and check it out. Social media, you can find us at Smart Property HQ. One favour for me, Paul's never done this, or at least he probably hasn't asked anyone else.
Mate, check the ratings. I'll be one of the top 10.
Would you?
Guarantee you. I was early doors. All right,
we'll get your kids to do
I'm
a review.
I'm an early adopter.
Then.
You know that, Phil.
If you can give me a review, give the team a review on Smart Property Investment, wherever you listen to this particular podcast. We do get a kick out of it. It'd be a real favour for me if you could do that. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.